Next up is Michael Episcope at Origin Investments. Origin Investments been a long time partner of OpportunityZones.com for many years now. So really pleased to have Michael Episcope joining the program right now to present what's going on with Origin Investments. Michael, there you are, coming to us from Chicago, I believe. What's
Yes,
new?
Jimmy, great to be back. Yes, it has been a while.
It's great to have you back on the show. What's new with Origin Investments? What do you have for us today?
I'll be pitching Origin's QOZ 3, so our third opportunity fund, and specifically three deals. So I have the task of trying to go over three deals in my time frame here of 20 minutes. So I can jump in whenever you're ready.
Perfect. I'm ready when you are, and the floor is yours for the next 20 minutes. So without further ado, please proceed when you're ready.
All right. So Jimmy, I'll jump in. I'm going to go over a little bit about Origin. I'm going to talk about the three deals. I have a few slides on those, and then we'll talk about the terms a little bit. And I think, just framing of the conversation, this fund itself is going to have just three ground up development deals, and I'll talk about those in a lot more depth. But the reality is that these are fantastic deals. We would love to have more diversification in this fund, but we'd also rather have the right three deals than just have five average deals in this fund. So here's a little bit about us, what you see in front of you, kind of the why Origin. We've been around since 2007. My partner and I started this. We've had a great track record. We've generated a 20% IRR on our development projects since inception. That translates into around a 1.91 multiple. And that has certainly come down over the last few years. The last few years have not been kind to any real estate developers. But I am proud to say we've never lost money on a real estate development, any holding in multifamily real estate either. And I know a lot of people, I think 3 years could say that, but the market has been anything but kind the last few years. And so I do think that's just attributable to good risk management. And I heard on the last presentation, somebody asked about risk, right? And risk is kind of all consuming in everything we do. And I like to think that, just keeping it simple, buy great real estate, stay away from, complex deals that, take a long time to do, leverage appropriately. We use, what I consider moderate leverage and, add value. And it's a very simple formula, but it's done well by us, and it's something that we'll continue to use in this market. So as a manager, we have about 3.6 billion in assets under management. We have 5 offices. We have 65 team members, and we serve the needs of around 5,000 individuals, and all taxable. So we serve individuals directly through our high net worth RAA channel as well. And we ourselves are two individuals here who my partner and I, David, believe in investing in what our own investments. Nobody has invested more at Origin than us. We've put in collectively almost $100 million in our projects, and we will be investing in this fund as well. Let me get to the next page. So, high level about QOZ Fund III, and I would just caution anybody to make decisions based on, projections. That's not what this is about. I would love to see people, put more emphasis on the quality of real estate, and I'm going to go over this. Projections are projections, and there's a lot that goes into these. I would think that, in ours, we underwrite extremely conservative here. And historically, we've beaten our projections every time we've done that. So we are multifamily focused. We have three strategies. We build, we buy, and we lend. So we see the entire ecosystem in our market. Jimmy alluded to the fact that I'm in Chicago. We do not invest here. We are Sunbelt only. Jobs and population growth, that's what we're looking for. Micro locations where we can really find great value and opportunity. And so, cities like Chicago, they just don't have the good, kind of long-term, durable fundamentals that we're looking for in markets. And yes, the Sunbelt markets are kind of, going through a supply issue right now. And we believe that this is a great time to break ground, deliver in, 26, 27, 28. And I think the world is going to look very, very different for a variety of reasons. This is a 10-year hold period like all the other funds here. I'm not going to go over that. And of course, you get the QOZ benefits of deferral and elimination. So this is the first deal I'll go over in the fund. Again, there's three ground up development deals. If anybody knows Asheville, it's a beautiful community. It's southeast, and it got pretty hit pretty hard in the hurricane as well. So we had actually closed on this property about a week before that hurricane, which, turns out it was actually good timing because Asheville has incredible housing fundamentals. Lot of demand, not a lot of supply. Certainly the hurricane set them back, but this isn't a city that looks like a FEMA site any longer. They've rebuilt about 80% of the retail is back. And this particular location, this is in the heart of Biltmore Village. So if you've ever been down here to the hotel. We're a few hundred yards from that. We're right in the middle of restaurants, retail, just walkable to amenities. So that's the first thing we look for is really, really high quality real estate. Where do people want to live? And certainly in a market like Asheville, where you're getting a lot of retirees, a lot of people coming down there, this sits smack dab in the middle of the action. And, it's irreplaceable real estate. So here is a little bit about the metrics about Biltmore Village. It is a Class A apartment community. You can see in the upper right there just a little kind of glimpse of the project itself and what we're building. And it's going to be a $78 million build. We're using about $31 million in equity. So, like I said before, typically, our debt to equity is conservative, moderate, whatever you want to call it, but it's about that 60 to 65%. We don't layer on preferred equity. We don't want more parties involved than we need to. And when you start layering up and, financially engineering the capital structure, that becomes exponential in risk. Projected IRR 13%. This is sort of our base case. Again, I think that's conservative, a 2.4 multiple. That's all without the benefits. So that's pre-tax, post-tax. And then your untrended return on cost. I'm sure other sponsors have gone over that. This is around a 6.2. I would put this property because of its location, if it traded today, inside of a 5% cap rate, 4.75, right around their five. So we look at development margin when we're looking at return on cost, and we're right around 30%. And so certainly if you have urban infill properties with higher barriers to entry, those are going to trade at lower cap rates than you are if you have, ex-urban properties where, you're kind of in places like Houston or something like that, not to pick on Houston, but where you can just build all day long. So, it's just something to think of. And then the other thing, after you're done building, you have to grow rents. So what is the rent growth in that community over the next 5, 6, 7, or 8 years? And in all cases here, you'll see that they're all above the national average. So we're forecasting rent growth of 3.44%. And the way we come up with that is that we have our own proprietary data set internally. We actually hired data scientists about 5 years ago. We have a tool called Multilytics that's proven to be incredibly powerful in both identifying the right sites, value, but forecasting rent growth at the micro level. So we employ that in everything we do, whether it's buying an asset for existing DST, doing ground up development, or for our credit platform. This is a snapshot of the underwriting, and certainly this isn't comprehensive. I just wanted to give you kind of a view of how we look at the world here. And if anyone wants more detail on the underwriting, I am happy to send it to you because there's a large brochure that we look at in investment committee that goes into much, much more than this. But one of the areas that we focus on a lot is just price per pound. What are we doing? Does it pass the sniff test? What are we building for on a cost per square foot, on a price per unit? And in this, you can see Biltmore Village is on the left there at $319 per square foot. And the other comps, comp one is extremely inferior. It's going to be 10 years older by the time we deliver our project. So it doesn't scare me that sold for $301 per square foot. You start looking at comp two and comp three, and that makes you feel a little bit better, with our build. And then when you're qualifying these, you have to look at the location attributes. You have to look at the amenities. You have to look at, all the other attributes of your building and how it compares to your comparables. And I will just say in this, we have a better location, we have better amenities, we just have a better building layout, we're going to be newer. So all of this is just to say like this really checks out on a price per pound for us. And then the rents, we do the same thing, looking at them, comparing the rents. And that's what untrended means is that we're looking at what are the rents today versus our build costs today so that we can understand where the risk is. And of course, if rents continue to grow into the future, then the project will do better than what we've underwritten on an untrended basis. So this is a property. This is kind of the what I'll call the anchor property. One I'm super excited about. This is in Scottsdale, Arizona. And if anybody is familiar with Scottsdale, it is the number one driver of job growth in the country right now. Number one, not number two, not number three, number one. I mean, the things that are happening here are just absolutely insane. And this particular property is called Modera Old Town, and it sits right in Old Town Scottsdale. So when we talk about barriers to entry, there is no property that has larger barriers to entry than this. You are right in the heart of Old Town, which is one of Scottsdale's most vibrant retail communities, walking distance to everything. Getting entitlements here is next to impossible. We've been working on this with our partner for the last year, and they were working on it for many years before this too. So to assemble ground here and then actually get the entitlements is next to impossible. So huge barriers to entry. Here are some of the metrics on the property. I've already gone over everything on the left, but I'll give you, this is actually a $100 million build. We're going to put in 36 million. So back to that 64% debt to equity. And then the projected IRR is going to be about 13% over 10 years with a multiple 2.8%. And that's on an untrended return on cost of 6.2. And again, I think the Biltmore is a fantastic property that would trade for 4.75 to 5 today. This property, I don't even want to guess, but I know it would trade well within 4.75, probably even a 4.5. And we have to think about that. And when we look at this, it's sort of that development margin. What is the difference between current cap rates today and your untrended return on cost? We're always looking for something north of 25%, 30%. And if we can get that, that's amazing. And generally in locations like this that are absolutely irreplaceable, you're not getting that kind of margin on the development, but you're thinking about holding this for the next 5, 10, 15 years. And so what really matters is, getting the dirt, getting into this location, and then rent growth taking over at that time. And if you look on the bottom right, our Multilytics is forecasting projected rent growth in this area of 5%. So you take the margin of the development and then you add 5% rent growth on that. And this project has just a lot of great upside opportunities. And I firmly believe there's an upside tail from here. For those who aren't as familiar with Scottsdale, I highly encourage you, just Google it, what's going on there. I've been there. We had an event there last year with some investors. We were at a steakhouse. I felt like I was in downtown Miami. I couldn't believe the amount of wealth there, the Lamborghinis, the Bentleys, everything showing up. And I think, I go down there quite a bit, but that was just absolutely eye-opening because this is one of the wealthiest areas in the entire country here. Again, here's the sales comp analysis. This is a podium deal, meaning we have our units above a parking garage. So we're building. It's much more expensive to build. This is part of the zoning, part of what the city is requiring us to do, and our comps all reflect this type of construction as well. It's just more expensive, and then obviously if you're building for a lot more, then you need to rent for a lot more, and that's why. Again, we're in one of the most affluent areas in the entire country, and that doesn't really scare me in this location to try to achieve the similar rents to what the comps are getting. So you can see our build costs are at about $500 per square foot. Comp one is 630, comp two 575, and comp three 532. They're good comps, but they're going to be older than ours. We're delivering in 2029. You've got comp two that's going to be 7 years older, and this is all looking at kind of today's rents, and we think there's room to grow in this area. So I feel really good about our basis here, about the rental, the underwriting, and all this is available if you have interest. This is the third deal. Hopefully, I'm doing well with time, even with my snafu on the technology side. So
Yeah,
this
you've
is
got a few minutes left.
okay, good, good. This is my last deal I'm going to cover, and then we'll go into Q&A. This is Two Rivers. This is up in the Wesley Chapel area. This is north of Tampa by about a 30-minute drive. And Two Rivers is part of a 5,500 master plan community called Two Rivers. And if you think about like what's happened in Tampa in the last few years, rents there have climbed by 30, 40, 50, 60%, and people have started moving north and people have started moving east for more affordability. Pasco County, which is where this property is located, is the third fastest growing county in the entire nation. And so, like, the first thing we look for in anything we're doing is there population growth, is there job growth? And this absolutely answers that question. But it's a very different project. This is garden. This is trying to meet the intersection of affordability and lifestyle, cost and value, so that when people are moving away from the downtown center of Tampa and looking for a more affordable option in the suburbs, this is an option for them. And any of the renters in this community, they also get the benefit of everything happening in the master plan community. So they get access to golf courses and fitness centers, and the schools in this area are fantastic. And there's a healthcare system nearby. So it feels like you're in a very well-developed suburban area, but you're renting for far cheaper than you could in downtown Tampa. This deal is going to be $91 million, $34 million of equity, kind of similar to returns to the other two deals. Untrended return on cost is going to be around a 6.3 right here on our underwriting. And that, this deal would probably trade for about a 5 cap today. So we look at that margin. What's the untrended return on cost? What's the cap rate? Looking at that. And so that's about, call it a 25% margin. But more importantly, what's the rent going to do over the next 5 years? This has the highest projected rent growth of any property that I showed before, right? Any property that I've seen in a long time. That's what we're excited about this deal, because it's really about like that affordability and the ability to continue raise rents in this environment. And so this is a phenomenal deal. We think we're meeting the market, with the renter profile as well, and it pencils out. The underwriting kind of establishes that as well. These are the sales comps. We're in at 276. You can see to the right, they're right around 300, 350, 317 per square foot. So those properties, though, are not in the master planned community. They are, it was actually very difficult to comp properties in this, and sometimes we do struggle with that. We have to go a mile, 2 miles, 3 miles away from this, but we like this because it sits right in the master plan community, and it's an absolutely great project, and we're excited to add that in these. Summary of terms, I'm not going to go over this, but I assume that this deck is going to be sent to everybody. You can review this. I just want to, in the interest of time, get to the end and get to Q&A. This is a contact page. You can always reach out to me directly at Michael at Origin Investments. You can go to our website to learn more. So thank you for listening. If you're on a recording, thank you for that. And if you've been sitting here the whole day listening to all these pitches, so I appreciate you hanging in here till the end.
Yeah, this is great. Yeah, I do really appreciate all of the attendees today. It's been record attendance or pretty darn near it. I had a lot of interest in opportunity zones the last several months since the One Big Beautiful Bill Act was signed into law. Let's see, we're going to move on to U.S. Energy QOZ Fund with Fred Gratz in just a few more minutes. Fred, I see you there. Sit tight. We're running a few minutes behind schedule. Want to make sure Michael gets his full allotment of time. So we're going to get to a few questions here. This first one comes in from Joe. Actually, more of a comment than a question, but he says, I have read about Moderna in Arizona. I live in Paradise Valley. Lots of growth here in Scottsdale. Very excited for the opportunity here in the next 5 to 10 years. I wonder about a couple lots in Biltmore that could use a new mid-rise. Any plans to do anything in Biltmore there, Michael?
You're talking about Asheville?
He's talking about the Scottsdale area, I believe.
The Scottsdale area.
Yeah.
Not right now. So we don't have any plans, especially not in OZ. We just did a large project in one of our other funds. It's by the Mayo Clinic. It's called Azola. It's North Scottsdale in that area. So we do like Phoenix as a market. We're just cautious about how deep we want to go into a single market. But certainly, like the the energy there and the job creation and the population growth is palpable. So I envy you, especially this time of year, because while it's turning, 40 degrees and, really awful out here, you probably have 75, 80-degree beautiful weather. So I do see why people live there year round.
Joe also just chimed in to say that he's emailed you a couple times in the last week or so. He's been studying your PPMs from start to finish. He's listened to 4 episodes of you as a guest on podcast, maybe even one of mine. I'm not sure because I know you've been on my show a couple times.
Yeah.
He says you are a highly intelligent individual that I look up to in the development space. I would really love some time to chat, but I understand you're swamped. So uh, hopefully Joe and Michael can get a little phone time here at some point when Michael comes up for air. He is a busy guy. I
Yeah.
appreciate his time today, being able to join us on Uzi Pitch Day. Thank
Joe,
you, man.
happy to. Thank you for the compliment.
All right, awesome. Let's see. We had a question here that asked, do you think any of these locations of these 3 sites that you just presented will be eligible OZ 2.0 tracts?
No, I don't. And I failed to mention that. Like one of the advantages of investing in this fund is that every one of these sites, they will not be in the QOZ 2.0 map. And that's what I would, the benefits are going to be better to invest in a year, the tax benefits. I don't think the sites are going to be nearly as good because keep in mind that these sites are based on the 2010 census, and there's so much that has changed that's the advantage. And I would say that the first order of operations when you're making a selection is it great real estate? And then look at the tax benefits. So we're excited about this. I know it's coming to the end of the program. Some people are, have a little hesitation because they're not getting the benefits, but it's going to be hard out there, with this new map.
I agree with you, Michael. I think if you look at the, let's look at the top decile or top quartile of opportunity zones in 1.0, compare them to what the top opportunity zones in OZ 2.0 may look like. The OZ 1.0, the economics are just going to be better for the very reasons you mentioned. The eligibility criteria was more broad. They've also had an extra decade essentially of development under their belt. The data is much older, so I agree with what you're saying there completely. Tax benefits will be better, but the locations for OZ 1.0 hard to beat for OZ 2.0. Let's see a
Yeah.
couple more questions here. Bill wants to know: can we invest outside of QOZ with Origin? I do believe you do have several non-QOZ offerings as well. Is that right? Any of the notable right
Yes,
now?
we have an income plus fund. We have a credit fund. We have individual deals sometimes that we bring out to investors. Those are generally, we don't bring those out to the public that often, but the one I was talking about, Azola, that was quite a large deal. I want to say we had a $40 million sidecar on that deal that got filled up in about 2 weeks. So that was, I think, somewhere around last year. So it surprised everybody given the appetite for real estate in this last year. But yeah, absolutely would love to talk to you about that. So if you don't, have a need for OZ, just reach out and I'll, happy to talk.
I guess Bill wanted to clarify: can we invest in these 3 projects outside the QOZ?
No, Bill. The answer is so the only exception would be this, right? If we don't have enough to capitalize a deal, we always bring those out to our fund investors. As I said, very rarely has a deal ever not been fully capitalized. So a lot of times, like we would first go out to our QOZ investors if we needed to do a sidecar here, and then that's what we would do because it wouldn't even get beyond that. So we always try to reward our loyal investment partners first.
That makes sense. Let's see. We got time for 1 or 2 more questions before I'll move on. This one comes in from Jerry Rice. And Jerry, good to see you here again. Jerry said he was surprised to hear that the Scottsdale area was the leading city driver of job creation in the country rather than it being in one of the Texas cities. Is that a function of the chip factory being constructed? Although he mentions a similar chip factory is being constructed by Samsung in Taylor, Texas, just outside of Austin. What are your thoughts there, Michael?
That actually has nothing to do with the chip factory. That hasn't even hit the market yet.
Hmm.
So if you look up Scottsdale job growth, Scottsdale employment, just do that. You get all of the employers. There's too many to name, but it's every big employer, and it's mind-boggling because you don't think about Scottsdale in that way. But it is the number one, yeah, job growth center in the United States, and a lot of healthcare technology and the TSMC, the Taiwan Semiconductor, that's going to be built, but that's going to take a long time. That's only going to add fuel to the fire.
Perfect. Michael, we're out of time. I think we answered all the questions. Thank you again so much for your support of opportunityzones.com over these many years. We've been partners together for a while here. It's great to get you back on OZ Pitch Day. Hope we have a great rest of your afternoon and evening.
Thank you, Jimmy. Appreciate you having me on. Great to see you. And thank you, everybody, for listening.